Well, yes, on the eve of the budget, we'll talk about what macroeconomic policy largely entails. It comprises of three major pieces. One is, of course, the fiscal policy. The second is the monetary policy. And third is the exchange rate policy. I'll cover these three in brief, but let me first cover the goals, the real agenda behind macroeconomic policy. It's to provide stability to the larger economy. Couple of things here. One is, how do you provide stability? Good employment numbers, good income generation, good wealth creation, right? Across that board, if you're able to meet those objectives, if your GDP per capita is going to go up, and at the same time your incomes are going to go up, and the lowest segments of the economy are going to start participating in the functioning of the economy, it largely will mean that your macroeconomic policy is stable and is doing quite well. Now, let me cover the three parts that we spoke about of macroeconomic policy. One is the fiscal policy. That is typically governed by the budget. What is fiscal policy? It gives you a summary of the incomes and the expenses of the government of India. The incomes largely include taxes. Now, within taxes, you have direct taxes and indirect taxes. Direct taxes are largely taxes which are directly claimed by the government on your incomes. It is claimed by the government on the income that you earn every year, and it depends on tax slabs. Indirect taxes are largely charged by the government indirectly on the population as a whole. So anyone making a purchase, no matter what income bracket you are in, will have to pay indirect tax on his or her purchase. And that's largely the difference between direct and indirect taxes. Moving quickly on, you also have other government incomes like investment incomes. The government runs various businesses like various public sector banks, public utilities, and from that, the income that gets generated, whether it is capital gains through divestments or whether it's dividend income from the profits that these enterprises earn, come back to the government, and they are able to spend that money on the larger development. Now, coming to the expenses side on the larger development. Within the expenses basket, there is CAPEX and there is REVEX largely, which is capital expenditure and revenue expenditure. Capital expenditure is more longer term in nature. It is spent over a period of 2, 3, 4, 5 years, like building of roads. Say a highway may take 3 to 4 years to build. And revenue expenditure is an instant expenditure. That is largely what the government spends on a day-to-day basis, like running government offices, like running the income tax department. Those are largely revenue expenses which the government continues to spend on a daily basis. So now we have the differentiation there. The difference between the two is what we call the fiscal deficit or the fiscal surplus. Surplus, of course, in the case where incomes are more than expenses. Deficit, of course, where expenses are more than incomes. Largely, India has been running a fiscal deficit, and that deficit is largely financed through borrowings. The deficit is currently around 6% of GDP. It is elevated in comparison to past years, largely because of COVID. So you had COVID, which pushed the government to spend more on both REVEX as well as CAPEX, and that has really led to a larger fiscal deficit. Let me move on to monetary policy. The RBI policy will come out next week as well. That will largely govern the manner in which monetary policy or interest rates will go up and down within the economy. That also indirectly influences the cost of capital on investments as well as on CAPEX, private sector CAPEX rather. So both of these cogs are vital to the larger economic machine. Then, of course, the last piece of the puzzle is currency. How the currency fluctuates and how the currency is largely controlled. And that also, to a certain extent, is controlled by the RBI. Now much fluid, but at the same time still controlled by the Reserve Bank of India. That is also part of what the MPC or the Monetary Policy Committee does. That's largely what macroeconomic policy is all about.